So now let's talk about where we shook out from a valuation standpoint. So thank you to all of y'all that did the hard work, submitted your values, and all the questions that went along with that. We pulled it together and we've got a few things we want to talk about. So first, let's just talk about where did we shake out. And not surprisingly, we had a pretty wide range of outcomes in what people thought the value were. On the low end, like $80 million all the way up to $218 million on the high end. And while that may seem like a wide range, when you break it down, what really happens is that about 70% of the valuations fell between 120 million and 160 million. And that range, I really call it 100 to 160, is where most people were narrowing in through this valuation process. And that's pretty typical if you were to go out and get bids on an asset that you would see something like this. You'd have a wide range of potential buyers who would come up with a range of different values. And what you're really going to start to do is say, who are my likely buyers? So looking at this chart, your likely buyers are going to be the people on the high end, right? The people that see the most value, have the most optimistic take towards cash flows and risk of that asset. And so we'd want to start focusing on those buyers and understand how realistic are they. What you might find, though, is if you start diving into the numbers of the bids that were 180, 200 plus million dollars, there's some assumptions in there that really just aren't quite reasonable for the market. And so what that tells us, if you're sitting in the analyst seat of CPPIB and you're trying to figure out, hey, what is the value of this asset? You have to balance. Of course, you want the most money if you're selling your share of interest in the asset. You want to get the most value for it, but you also have to make sure that that's a realistic value and that the assumptions used are realistic. So looking at this chart here, you might dive into some of those bids on the high end and see exit cap rates that were in the low fives or mid fives or low sixes, which just don't track with today's market, or market rent growth assumptions that weren't realistic, those types of things. So it's diving into the details, but what's important to know is the market will dictate what the value of this is, and it won't be based on the average of the bids, which was like 135 million. It's really going to be about targeting who the most likely buyer would be, which means they're optimistic towards cash flows and risk of the asset. So James, what do you think about kind of where the bids came in? Any takeaways on just where the purchase price of everybody arrived?
Couple thoughts. One, I think it's important to level set and really to dive into what you're talking about around assets are not priced on average. They're priced on the margin. That is so critically important when you're dealing with anything related to valuation. So let's take a big step back. What type of valuation are we coming up with? We're not trying to come up with the value that you in particular would pay for this asset. That is not what we're trying to do. What we're trying to do is come up with a valuation that is reasonable, but market. What does that mean? It basically means what is the most optimistic but credible bidder believe this thing is worth, right? Why is that the case? Because let's rewind to when we launched this case study. You are an analyst that works for a pension fund that is partnered with a big office owning real estate company. You own a partial interest in this asset that you no longer wish to own. You're going to call your partner and say, listen, I would like to sell. I want out of this. The partner is opportunistic. If they smell blood, if you will, they're going to say, look, if you really want out, then we'll buy you out. And then you're going to get into a combative situation potentially where it's in their best interest to buy you out at the lowest number possible while you want to maximize your value. So before you go through that entire process, which may end in you disagreeing and bringing it to the market, internally, every time someone goes through a process like this, before they really kick that off, they're going to say, hey, what do we think our interest is worth? And not just what we're carrying it at, And not just what are we carrying the value at, but what do we think it's actually worth in the market. And so I think the first important thing is just to define what are we trying to do. And we deliberately didn't give you a lot of guidance on that because it's an important distinction. What we're trying to do is estimate, again, what is the highest credible bidder willing to pay for this asset. And so I really like what you said, Richard, about, first of all, you see this spread of values. This is pretty common. All you need, common meaning you see a big fat part of the curve sort of in the middle, and then you've got a couple outliers on both sides. The outliers on the bottom side, I would call bottom fishers. They're just throwing bids out to see if no one else shows up, then maybe they close, throw those out. The outliers on the top, you're immediately going to focus on them as the seller or the potential seller, because I want to know, are these buyers credible? If they're not credible, you throw them out, right? If they are credible, that's very interesting. You want to get the highest credible bidders. And then the way you get max pricing for any asset is to get multiple bidders competing for it. And so you're really trying to size up, where can I get that competition brewing? And you can't do that unless you have a really good understanding of the asset. This is why people say that valuation is part art, part science. Because as Richard was pointing out, and I like the way you frame this, if I go toward the top part of this curve, someone thinks this thing's worth more than $200 million. But if you peel back the layers, I bet you're going to find a very aggressive exit cap rate, a relatively aggressive occupancy profile. So call it 5% or something in an asset that you know is going to have a lot of rollover. A relatively aggressive rent profile potentially. And then typically you'll see someone taking a very much glass half full look at capital. So tenant improvement allowances and things like that. You're going to get all of that packaged into too aggressive of evaluation, which is going to be extremely hard to capitalize. And so I would probably deem that, without knowing a whole lot about what was behind that valuation, is not credible and throw it out. Where I'm really going to focus is on those top two, or the bars that are over to the far right, from 160 to 200 million. I'm going to try to get as many credible bidders as those are. And what does that mean in this instance, where we don't actually have bidders? You're trying to connect the dots from where is that capital, what sort of returns do they need, what sort of debt capital do they need and can they get, and then how would they underwrite the cash flows, as we've talked about before. Once I get to that triangulation that will stand up to criticism, now I'm on a really good track to tell you where is the highest credible valuation. And those are the numbers that I'm going to go back to my boss and say, listen, I've really kicked this around, and I think that a credible range of valuation for this asset is between 180 and $200 million, which is a relatively wide range. But I can tell you why. On the top end, it's a 7.5% general vacancy number, $75 a foot in TI, and I'm basically being pretty aggressive on the renewal probability of the tenants that are there. If I assume a lower renewal probability, a little more capital, and slower rent growth, then I get something more like 180. And on both of those, I'm getting to a low double-digit discount rate. So that's sort of the mentality that you'd be talking about, and the nomenclature that you'd use to communicate why you think this range of valuation is reasonable.